time for business now on Prime News Paris, and I'm joined in the studio by Kate Moody. Hi, Kate.
Hi, Yinka.
Good to see you. So, America's central bank has cut its key interest rates for the third and last time this year.
Yeah, the Federal Reserve began raising interest rates back in March 2022 to help combat high inflation. It then started cutting them this September as prices calmed. High interest rates tend to fight high inflation by encouraging consumers to save rather than spend. Now, Wednesday's 0.25% move brings the federal funds rate to a range between 4.25% and 4.5%. That is the lowest in 2 years. It's a full percentage point lower than just a few months ago. In September, the Fed had suggested it would cut that headline rate a further 4 times in both 2025 and 26. Policymakers now expect only 2 rate cuts each year, with a target range of just under 4% for the end of next year. The Consumer Price Index, which measures inflation, stands at 2.7%, while the Fed targets 2% inflation. Take a listen to the Federal Reserve Chairman Jerome Powell speaking earlier.
We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course.
Let's bring in Rodney Sullivan, Executive Director of the Mayo Center of Asset Management at the University of Virginia's Darden School of Business. Thanks for joining us on France 24 this evening. Remind our viewers, if you will, why this interest rate decision matters. How are lower interest rates supposed to impact the cost of living?
It's a great question, Kate. Thank you so much for having me. This is so important because, as we know, the Fed's dual mandate is maximum employment and stable prices. And so if we want to achieve, and the Fed does want to achieve that dual mandate, the level of policy rate matters a great deal.
To what extent do you think the Federal Reserve can really be credited with bringing down inflation in the U.S.? CPI, if we look at it, stood at about 8.5% back in March 2022. It was down to 2.7% this November. How much of that move is linked to things like changing market conditions and supply chains being opened up, factors that the Fed does not control, and how much of it is linked to Fed policy, in your opinion?
Yeah, it's a great question, Kate, and certainly it's a confluence of factors. The Fed policy rate is very important to bringing down the rate of inflation, and you'll see that once the Fed started raising rates, the inflation rate did begin to come down. As well as you suggested, supply chains became looser and other factors as well fed into it. But the signal that the Fed is giving is that they intend to break the back of inflation and to bring it down to their target rate of 2%.
Now, as you mentioned, Rodney, the Fed does have these 2 mandates. Controlling inflation is one, but the other is supporting a healthy labor market. Hiring has cooled slightly in the U.S., but wage growth remains pretty strong. What do you expect for the U.S. labor market in the months to come?
Yeah, let's back up a bit and look at a wider lens. The economy for the past 2 years has surprised on the upside, at least in the U.S. Most people expected us to have a dramatically slowing economy and even a recession in the last 18 months. That simply hasn't happened. And so the reason that hasn't happened is because we have indeed, as you suggest, Kate, a strong labor market with rising real incomes. So what that has meant is that consumers have been quite confident in their spending, and businesses as well have been investing. As you know, we have a very strong AI boom that's occurring right now. Alongside that is a rise in productivity. And that rise in productivity has also helped to keep a lid on inflation. It's not well understood or well discussed, but it's a very important contributor. Rising labor productivity means that businesses are getting more output for their employment input, if you will. And of course, you can see how that feeds directly into keeping labor costs down and rising real incomes. So it's a confluence of factors that have played into this very strong economy. And it looks like, Kate, that looking ahead, this strong economy will likely continue. although markets are sort of reacting negatively today to the Fed announcement, if we again pull back and look into the next 3 to 6 months, we see the economy continuing to be strong because of this robust consumer. Spending continues to be strong with businesses. And having said that, this means that the economy is likely to remain robust in the coming months. It may not happen, but that seems to be what we're setting up to be.
Rodney, I'm going to have to let you go in just a moment. Can I just briefly ask you what you think we might expect from the incoming president, Donald Trump? He has said that he prefers low interest rates. Are you expecting any sort of clash between him and Jerome Powell, who is supposed to be able to operate independently?
I don't expect any clash. I mean, Jerome Powell has said that they intend to work independently. But what a GOP sweep does mean, Kate, and we have seen that as of November 5th this year, is we will likely see more stimulative policy, meaning lower tax rates and higher child tax credits and more deregulation versus what we've seen in the past. Again, all of these factors feed into a robust and stimulative outlook for the coming months.
A lot of factors, a lot of moving parts there to keep an eye on there. Rodney Sullivan from the University of Virginia's Darden School of Business, thank you so much for joining us on France 24. And just a quick note, analysts are now expecting the Bank of England not to follow suit and cut its own interest rates on its policy meeting this Thursday. That's because consumer prices in the UK are still rising 2.6% higher in November than they were a year earlier. That is the second month in a row that inflation has risen in the UK and the fastest pace for UK inflation since March. Yinka will be keeping an eye on the Bank of England tomorrow anyway to see what they decide.
We very much will. Kate, thanks so much for that. Kate Moody there with the latest in the world of business.